Perhaps we switch off the video and we come back, I'm assuming.
Great. Assalamu alaikum wa rahmatullahi wa barakatuh. Distinguished speakers, respected guests and valued participants, ladies and gentlemen, brothers and sisters, a very good day to all of you joining us today from Bahrain, and of course around the world. My name is Al-Fatih, and on behalf of the Bahrain Institute of Banking and Finance and the General Council for Islamic Banks and Financial Institutions, CIBAFI, it is my great pleasure to welcome you to today's webinar titled Enhancing the Resilience of Islamic Banks in the Face of Global Exogenous Events. Ladies and gentlemen, in today's highly interconnected global economy, financial institutions are increasingly exposed to external shocks, including geopolitical tensions, economic volatility, technological disruption, climate risks, and of course, global pandemics. These exogenous events can significantly affect financial stability, liquidity conditions, and institutional resilience. Islamic banks possess unique structural characteristics such as asset-backed financing, risk-sharing principles, and ethical governance that may help strengthen resilience during periods of global uncertainty. Through this collaborative webinar, BIBF and CIBAFI aim to explore how Islamic financial institutions can strengthen their ability to anticipate, absorb, and adapt to external shocks while maintaining sustainable growth and financial stability. Today's discussion will bring together industry experts, policy advisors, and leaders who will share insights on risk management, macroeconomic developments, and strategic policy responses relevant to the Islamic banking sector. Ladies and gentlemen, before we begin, please allow me to take a bit of your time to make a few announcements. If you've got any questions during the webinar, kindly write them in the chat box. We'll address them during the Q&A session that we're going to have later. The webinar will be recorded and shared on our social media platforms in the coming days, inshallah. And last but not least, we would appreciate your feedback later at the end by completing the evaluation form after the session. Great. Without further ado, it is my pleasure to invite Dr. Rizwan Malik, head of the Islamic Finance Center at the Bahrain Institute of Banking and Finance, BIBF, to deliver his welcoming remarks. Sheikh, the floor is yours.
Thank you very much, Brother Fatih. Bismillah ar-Rahman ar-Rahim. Your Excellencies, distinguished guests, colleagues, ladies and gentlemen, a very warm welcome to all of you. A very warm good afternoon to all of you joining us from different parts of the world. It is my great pleasure to open today's BIBF CIBAFI event on enhancing the resilience of Islamic banks in the face of global exogenous events. We are certainly proud to collaborate with CIBAFI in putting together this timely discussion, reflected in the strong engagement with more than 500 participants registered from across the various jurisdictions. I also warmly welcome our speakers and panelists, colleagues from supervisory and standard-setting bodies, industry leaders, and everyone joining this event online. We certainly hope that it will be enlightening and, of course, thought-provoking, the aim of which is this is the aim of the event that we have today with us. Today, we will focus on what severe exogenous event mean for Islamic banks and the practical steps that strengthen preparedness, response, and recovery. Following these remarks, we will also be present with CIBAFI's new report, which is on the responding to severe exogenous events, a guide for Islamic banks, designed as a usable framework for banks and supervisors. I would like to congratulate CIBAFI under the leadership of Brother Hamza Bawazir on this timely publication. Ladies and gentlemen, as we all know, the past few years have made one point unmistakable. Disruption is no longer the exception. I remember since graduating back in financial crisis 08 or 09 that we have been in some crisis one after the other. And when we read history, it is apparent that a crisis of different nature happens every decade. The pace of this has recently increased over the last few years. Climate and natural disasters, geopolitical tensions, cyber incidents, public health crises, and sudden market shocks can all test financial institutions, often without warning, and the effect can cascade through payment systems, liquidity conditions, collateral values, and ultimately public confidence. One can easily refer to what we in the Middle East are going through as we speak. Exogenous, as Brother Fateh mentioned, means shocks that arise outside any single institution's control. They do not respect organizational boundaries, and because banking is interconnected, they rarely stay contained. Resilience, therefore, is not built during a crisis, it is built before crisis arrives. For Islamic banks, resilience is both familiar and unique. Our asset-based and risk-sharing foundations are strength, but they do not insulate us from shocks. They change how stress is transmitted across balance sheet and stakeholders' expectations, and they raise the bar on trust. In a crisis, communities expect Islamic banks to stay sound, stay open, and stay faithful to Sharia, acting with fairness, transparency, and a spirit of partnership. This truly calls for a regular scenario planning exercise that is built into systems and procedures. Long gone are the days where we are planning the 10-year plan, the 5-year plan, and even at times 1-year plan. They most likely are no longer effective. There is a need for a dynamic plan based on economic variables on a regular basis. We have seen this during COVID-19. Many Islamic banks across the Gulf Cooperation Council and Middle East, the Greater Middle East, showed that its resilience was not determined by capital alone, but by governance, readiness, board management, risk committees, and Sharia governance aligned in advance, able to act decisively while maintaining compliance. The underlying principles on which Islamic banking and finance is based also protected the customers from some of the refinancing related matters. While the conventional banks went on to refinance loans at a markup, Islamic banking customers to a large extent had a hedge against such an increase. We have recently, of course, in the Middle East undergone a similar type of crisis, which has impacted global supply chain, pushed up the prices, and of course impacted the real economy. Resilience cannot be defined narrowly. It is capital and liquidity, yes, but also governance that works under pressure, operational continuity when assumptions fail, and crisis decisions that remain Sharia aligned even when time is limited and information is incomplete. Of course, there are a number of things that we have to look at. First of all, governance that works under stress, clear escalations, defined decision rights, and pre-agreed coordination between the boards, management, and the Sharia governance. Second is forward-looking risks intelligence, stress testing. This is relevant to all organizations, all institutions, not only Islamic banks, but the need for stress testing has become even more important. Operational and people resilience. Of course, people and technology is at risk when there's disruption. So there is a need for us to look at their ability to operate through disruption. And of course, the underlying principles on what Islamic banking and finance is based, how can that be relevant and resilient? So how Sharia embedded into Sharia governance, into resilience planning, could help us navigate some of the uncertain times. Across all the four disciplines, we have to prepare with realism, respond with speed, coordination, and communication, recover by restoring critical services and protecting trust, and then learn how disruption strengthens us in the next response. Bahrain, which is the hub for Islamic banking and finance for a very long time, reinforces an important point. Resilience is not built by institutions acting alone, it is built by ecosystems that align regulation, governance, talent, and market practice. Something that Bahrain has formed very well, in particular for Islamic banking and finance industry, where it is hosting most number of infrastructure organizations, including AOFI, CIBAFI, Islamic International Rating Agency, as well as other important institutions that are serving the global Islamic banking and finance industry. IAFM is another one. And of course, BIBF, the training arm of Central Bank of Bahrain, which is playing an instrumental role in the development of human resource within the global Islamic banking and finance industry. This is why today matters. Through this BIBF and CIBAFI platform, we can move from compliance-driven resilience to strategic resilience, the capability to withstand shocks that are inherent in the principles underlying Islamic banking and finance, while continuing to serve the real economy and our communities. Let me close with this. The next shock is not a question of if, but when. The choice is whether we prepare deliberately or respond reactively. At BIBF, and in particular the Islamic Finance Center, we support this effort by strengthening talent and preparedness through capacity building programs, initiatives, and executive programs, equipping boards, managements, risk teams, and Sharia governance with the skills and tools needed to consistently assist when disruption strikes. Thank you very much. I look forward to hearing the discussion that we have with us today. Inshallah, we are very fortunate to have subject matter experts from a diverse set of industries with us who will be sharing their knowledge, wisdom on the topic. And inshallah, wish you a productive discussion. And once again, we are very pleased to partner up with CIBAFI in putting together this event. And we hope this will bring new knowledge, enhance our understanding, and of course, help in the brainstorming new ideas and new waves. So thank you very much. Over to you, Brother Al-Fatih.
Thank you. Thank you very much, Dr. Rizwan, for those very insightful opening remarks and for setting the tone so effectively for today's discussion. It is now my pleasure to invite Ms. Zainab Al-Awainati, Director of the Administration and Finance at CIBAFI, to deliver her welcoming remarks. Ms. Zainab, the floor is yours.
Thank you, Brother Al-Fatih. Thank you, Dr. Rizwan. Assalamu alaikum wa rahmatullahi wa barakatuh. Good morning and good afternoon to all of you, wherever you are joining us from. It's a great pleasure to welcome you all to this joint webinar on enhancing the resilience of Islamic banks in the face of global exogenous events. To begin, I would like to extend our appreciation to our esteemed partner, the Bahrain Institute of Banking and Finance, BIBF, for their collaboration and commitment in organizing this important webinar. Reflects the Memorandum of Understanding signed between CIBAFI and BIBF, which formalizes a strategic partnership focused on knowledge sharing, industry development, and capacity building across the Islamic financial services sector. I would like also to extend a special thanks to our distinguished speakers who have joined us today to share their extensive knowledge and expertise. Your contributions are highly valued and play an essential role in enriching today's discussion. Dear colleagues, financial institutions today operate in a world where disruption are no longer rare events. They are becoming more frequent, more complex, and even more interconnected. These disruptions include natural disaster, geopolitical tensions, cyber incidents, pandemic, and shocks to financial system. They are often sudden, difficult to predict, and capable of affecting multiple sectors at the same time. So in this environment, expectations of banks have also changed. Regulators, customers, and society now expect financial institutions to continue providing critical services even during periods of severe stress. Maintaining operations, supporting customers, and preserving trust are no longer optional, they are essential responsibilities. For Islamic financial institutions, these responsibilities carries even additional weight. Institutions must not only remain financially and operationally resilient, but also ensure that their responses remain aligned with Sharia principles and their broader social role. And the insight from CIBAFI Global Islamic Banker Survey for 2025 confirms that risk related to major disruption and macroeconomic uncertainty remains among the top concern for Islamic banks. At the same time, the industry is navigating structural changes, including digital transformation, increasing reliance on technology and third-party providers, and growing expectations around sustainability and social impact. At a practical level, strengthening resilience today goes beyond maintaining strong capital and liquidity. It requires a more comprehensive approach where banks ensure that critical services can continue or be restored quickly, invest in strong and secure technology systems, reduce reliance on single service providers, and prepare for extreme, but of course, realistic scenarios. It also requires having a clear crisis response frameworks, often referred to as playbooks that guide decision-making during disruptions, while embedding a culture of continuous learning so that each event strengthens future preparedness. So in this context, it's given me a great pleasure to take this opportunity also to soft launch our forthcoming guide for Islamic banks entitled Responding to Severe Exogenous Events. This practical guide reflects extensive industry engagement and provide a structural approach to resilience, covering preparation, response, and recovery. It emphasizes also that resilience is not a one-time effort or a one-time assignment, but it's a continuous cycle of planning, action, and learning. It also highlights the importance of clear governance and leadership during time of a crisis, ensuring that decisions are timely coordinated and aligned with both financial and ethical responsibilities. At its core, building resilience reflects the maqasid al-sharia, the preservation of wealth, life, and intellect. These principles reinforce the importance of preparedness, responsibility, and long-term thinking in the way institutions operate and respond to crises. So today's session contribute to this broader objective. It's bring together the perspective on how institutions can strengthen resilience frameworks, improve governance and risk management practices, and of course, enhance cooperation across the industry. The partnership between CIBAFI and BIBF provides a strong platform to support these efforts and to drive meaningful progress in building a more resilient and responsible Islamic financial system. So we look forward to your insightful and impactful discussions. Thank you again for your presence. Thank you for your engagement and your continuing contribution to the development of Islamic financial services industry. Assalamu alaikum wa rahmatullahi wa barakatuh.
Thank you very much, mashallah, Ms. Zaina, for those valuable perspectives. You've certainly added further depth to the context of today's discussion. We certainly can't wait for the panel to start, but before we proceed to that, there is something important too that we must do. We will have a brief presentation introducing, mashallah, CIBAFI's upcoming report, which closely aligns with the theme of today's webinar and explores resilience of Islamic banks in the face of global external shocks. And to present this report, it is my pleasure to invite our dear brother, Mr. Rashid Al-Ita'i, Assistant Director of Strategic Planning and Operations at CIBAFI. Sheikh, the floor is yours.
Thank you, Brother Al-Fatih. And Assalamu alaikum, everyone, and welcome to this webinar. Before we move to the main, as mentioned by Brother Al-Fatih, to the main station of this event, allow me to share with you a couple of insights from our forthcoming report on very timely topic and theme and topic that is important to tackle in the industry. The report is titled Responding to Severe Exogenous Events, and it is in the form of a guide for Islamic banks to deal with any future disruptive events. And the report proposes a number of guidelines and recommendations on how to manage these exogenous or severe exogenous events, and most importantly, the events that can be categorized as the unknown of the unknowns. So allow me first to share my screen. And if someone can confirm that the slides are visible.
They are.
Okay, good. Okay, so as I mentioned, the report is titled Responding to Severe Exogenous Event, a guide for Islamic banks. And I will try to keep it short because the most important part will be the discussion that we will be having with the distinguished speakers in the panel. Let me first start with a simple question. Why this report and why now? If we look at this timeline, we will see that in the last 15 years, the world's financial system has faced a certain number of shocks, and one after the other, starting with 2008 crisis that changed the rules on capital and how we deal with liquidity. Then COVID-19 in 2020, there was a hit to the whole world at the same time, and it was a shock about people, not just about the systems. Then we have the conflict in East Europe between Russia and Ukraine, that started as a simple exposure problem, then became an energy problem and a cyber problem. Then conflicts and climate disasters are like frequent in YC countries. And in 2024, one bad software update from CrowdStrike stopped many services around the world. The honest message from this is that banks they managed throughout all these issues and shocks to cope, but they did not do it by preparing. It was really by improvising. So when we say severe exogenous event, what do we mean by that? And in the report, we try to give a clear definition to this term, and we try to define extreme exogenous events based on 6 criteria. First, the event should be severe, meaning that the impact is big, not just a small bump. It should be sudden. It happens fast with little time to react. It needs to be unpredictable, meaning that we cannot know in advance the exact shape, the exact timing, or the size of the impact. Infrequent, it is rare, not part of a normal cycle of events. Exogenous, meaning that it is coming from outside for example, the banking system. meaning that the bank cannot control it, and it needs to be abroad, meaning that it affects not only one bank but many, and it can go to other sectors at the same time. Why this is important? Because if all these six features or six criterias are present, then it means that nobody can really see the event coming with full accuracy. And so the conclusion is simple. We cannot prepare for the exact event, but we can build the ability to respond and the agility to respond. The report also shows five types of severe exogenous events, and then a sixth one that is the most important for our discussion today. First, we have the natural disasters. They happen more often nowadays and they are more severe. Second are the geopolitical events, and I think this is the trend currently. Third, we have cyber and IT incidents for the pandemics and the health crisis. And for this, they don't really impact directly the systems, but they go their impact is on people and it spreads to the systems. And fifth is the economic and financial shocks. And the sixth box is that you see in the screen is on the unknown unknowns. These are the shocks that we have not even imagined. The shocks that when they happen, people will start commenting that nobody could have predicted such event. And the message here, or the main message, is that the first five tell us what to test, and the last or the sixth category tells us why we must build flexibility, not only fixed plans. And there are three big lessons that appear in all the recent events that we experienced. First is the consequences that changes over time. Take, for example, the case of the conflict in East Europe. It started as a direct exposure issue, then it became an energy issue, then a cyber issue, then a sanction issue. So the risks of today are not always the risks of tomorrow. Second lesson is that severe events, they don't stop at the borders. Like, for example, pandemics or cyber attacks or even political shocks, they affect many countries at the same time. So there is a need for coordination between regulators, between banks, between countries, and this is part of a strong resilience or a good resilience. Third is the expectations that changes. Regulators now and banks or the society now expect that banks can keep working and to protect the customers and the communities even when they are under extreme stress. And this is no longer a nice to have feature. It is the minimum required from banks. So how can we get the banks to be ready for such events? This is exactly what the report's framework is about. And we are talking about three phases. And I think if you remember only one slide from this presentation, please remember this one, because this is the core of that report. The main message is that resilience is a continuous cycle, and this is something mentioned by Ms. Zainab in her introduction, not a one-time plan. There are three phases. The phase one is prepare before the event. So this means that we need to look at the risk appetite, financial strength, operational strength, and also the scenario planning. And most of the work happens during this phase. Phase two is the response during the event. This is the playbook, and it tells us or it tells the bank who decides, who speaks, and how to act under pressure. And the last or the third phase is to recover and learn after the event. This means that closing the loop, taking what worked and what did not, and putting it back into the system. And at the bottom of the slide, you can see that we are highlighting governance, leadership, and culture as the foundation for these phases to be implemented properly. The main message of the report on Islamic banks is that although we have the same architecture compared to conventional banks, but we have some specific points. So Islamic banks and conventional banks, they face similar challenges, but there are 6 points where we see differences when it comes to Islamic banks. And we need to take these points into consideration if we want to shape the preparation in concrete ways for any future events. First, Sharia compliant liquidity, Sharia compliant liquidity, because as we saw in COVID-19, some central banks emergency facilities that are based on interest are not suitable for Islamic banks. So having something specific for Islamic banks may not be available all the time. Second is the contracts and moratoria. So the wide payment moratoria during COVID-19 created some real Sharia issues. We have also the third point, which is the asset-backed exposure, when financing is linked to real assets, as the case is for Islamic banks. There is a possibility to have physical damages to these assets, which creates more extra risks for Islamic banks. Fourth is the concentration of Islamic banks in some specific geography, mostly in countries that do face natural disasters and some political issues. And the fifth element is the ethical and social mission. So Islamic finance has a specific responsibility to affected communities. So this must be part of the preparation, not only a response or something that we mentioned in the post communications. And then the last point, or the sixth point, is the governance integration. Sharia boards, they need to review, or they must review the playbook before a crisis, not just asking them questions only when the crisis arrives. The report also speaks to a four audience when it comes to the recommendation, because no single actor can build resilience alone. So for policymakers, they need to develop national resilience strategies, design Sharia compliant safety nets, and coordinate across borders. For supervisors to set clear expectations on operational resilience, include 7 severe event scenarios in stress tests, and coordinate with peers. For board of directors, and this is important, especially for Islamic banks, to take ownership of the risk appetite, statement of severe events, and ask for playbooks and lessons learned at the board risk committee. And the real challenge is the governance. The report is asking for a good governance, for senior management to build the resilience into the strategy and the culture, and practice the playbook instead of just filling them. And for the audience, it is one shared agenda. The last slide is about the key messages to remember from this presentation. Number one, and this is the main message: resilience is more than just capital and liquidity. We have spent 15 years rebuilding capital since 2008, and that was the right thing to do. But it is not enough today. So resilience also needs governance, a forward-looking risk appetite, operational playbooks, and structured learning. Number two, severe events belong on the board agenda, not in a small risk management corner, but inside the risk appetite statement, inside the strategy, and on the regular agenda of the board risk committee. Number three, Islamic finance values are a real strength in a crisis. The ethical and social side of Islamic finance can really make the difference in how a bank serves affected communities or small communities. So we need to take these values into consideration and to turn them into real preparation, not only used in communications after the event. So these are the principles, what they look like in practice, in exactly what and is exactly what what our three panelists or speakers are here to discuss. So let me now hand over to the panel by calling upon the speakers, starting with Dr. Yarmo Catalin, with the point related to macro environment. Dr. Yarmo is an economic advisor at Temkeen, Bahrain, and with the experience economics in the region, especially in the Gulf. What I want to highlight from the interaction with Dr. Yarmo is the the other channels or the transmission channels of exogenous shocks that we need to take into consideration. So from your point of view as an economist in the Gulf region, which of today's transmission channels of these exogenous events, for instance, commodity and energy prices, cross-border capital flows, supply chain disruptions, or even cyber and geopolitical channels, do you see as the most underappreciated by Islamic banks today? Over to you, Dr. Yam.
Yes, thank you very much to CIBAFI and the BIBF for having me at this very important and timely discussion. I want to join others in commending and complimenting CIBAFI for having produced this report, which is very much needed. Before I sort of go to your main question, I think the issue that we in some ways are facing today in Islamic finance is almost like a collision of two cultures or two worlds, two forces. On the one hand, we have what has been a very sort of gradual evolution of Sharia-compliant finance in the context of a generally conservative regulatory and governance culture, and of course, relatively uneven asset markets or Sharia-compliant asset markets that these institutions have worked with. So it's essentially a picture of this stability on the one hand, and then on the other hand, we have seen, as you very eloquently explained, the rise of systemic uncertainty due to a confluence of sort of structural and incidental drivers of risk in the early 21st century world. So the consequence of these realities, I think, has been a Sharia-compliant financial sector, which has a very heavy exposure to immovable assets, to real estate, amid this sequence of profound exogenous shocks that has tested both the stability and the growth, the ability to grow of that market. And of course, if anything, when we look at how, for instance, banks have evolved in the Gulf, the interest in real estate has expanded further because we've seen the mortgage lending segment in particular mature and grow as a key driver of personal credit. And I think the reality is that this state of affairs, this conflict between these two realities, has been both a source of instability, but I think very importantly a factor holding back the growth and diversification of Sharia-compliant finance, as risk management has tended to revolve quite heavily around conservative risk avoidance, precautionary buffers, often with very significant gold plating, which has really then curbed the resources available and the appetite for growth and diversification. Now you asked me which one of these risks are most underappreciated, and that of course is to an extent an academic exercise, and you referred to Donald Rumsfeld's unknown unknowns, so there's a big element that we don't necessarily can't even fully appreciate yet. But I think the reality is all these clearly now exist, and they have repeatedly made themselves felt. I think what is in a sense the most familiar, most rehearsed, certainly in the Gulf, but I think the region more generally, is the commodity and energy price risks, in the sense that we've seen several bouts of commodity price volatility, quite regardless of what the actual initial triggers of this volatility have been. And I think certainly in the Gulf, but to an extent more generally, the old transmission channels of oil influencing government receipts and banking sector liquidity, they tend to remain very strong despite this ongoing economic diversification. And I think that these factors, in many cases, they have been a driver of recurrent volatility, for instance, in the regional property markets, and this is why Islamic financial institutions are affected. Above all, obviously, in countries, especially the UAE, where real estate development has been a key plank of economic diversification. I think they have also, especially now during this current crisis, raised important questions about the right balance between relying on these potentially temporary visitor, resident, and capital flows, and I think a renewed interest in issues like immigration policy. Now, I think if I were to give my view of what banks are potentially underappreciating, I think cyber risks are almost certain to increase in frequency and intensity amid this rapid and in many ways accelerating and discontinuous evolution of technological change, which is increasingly powered by ever more powerful artificial intelligence. And the reality very often is that the ability of institutional culture and legacy systems to keep up is very much in question. And I think what we are seeing there is a kind of a perpetual game of catch up. Another issue that sadly, as we are seeing, is very important and probably likely to intensify is geopolitical risks. We now live in a world where international law, international conventions are being challenged. Technology is changing rapidly, and that's good for the good guys. It's also good for the bad guys, paradoxically. We are facing these structural, demographic, climate-related, and economic pressures that are becoming ever more structural and entrenched. So one particular risk, for instance, for much of the Islamic world is the potential impact of climate change on water, which may well become, many people think it will become, an increasingly important driver of social strife and conflict. So I think the issue is how, as you pointed out, how forward-looking, how strategic is the risk management culture at IFIs. And I think today the risk is that we still live in this reactive culture. We tend to end up fighting the last war when new surprises are coming down the pipeline. And the other issue is that risk management today still tends to be generic. It is not risk specific, and it is very seldom proactive. One final point I would say on this is it is important for us to remember that survival, getting through the crisis, is not enough. Islamic financial institutions, as all financial institutions, are at the service of the broader economy. And I think there are bigger questions as to how do we make sure that these institutions not only manage through these crises, but also play a positive role in building resilience in the regional economies. And they all have significant development needs in general, but also significant structural needs to build further resilience.
Thank you, Dr. Yarm. And this is a very useful map on the risks that that could face Islamic banks, but also the banking or the financial sector as a whole. Let me push you on what to do about some specific risks. As we mentioned in the report, most of the Islamic banks, they are operating in regions that are experiencing some kind of these severe exogenous events, for instance, natural disasters or even geopolitical risks. So the question is, how should Islamic banks start pricing, not just disclosing, but really to price these risks, for instance, the climate or geopolitical risks? And let's give that a timeline of 3 to 5 years. And what does the look that look like for capital planning, for financing tenors, or even for the geographic strategy?
This is a very good question, and it's a very important question, and I'm not sure that I can really do it full justice through my response. I think it is important for us to recognize that today, of course, all jurisdictions seem to be increasingly exposed to natural disasters. So it's not just the Arab world or Islamic world, but I think what makes this part of the world particularly vulnerable is that many of these countries, not least, of course, the GCC, are characterized by very sort of extreme climatic conditions to begin with, which means that they are vulnerable to begin with. In many cases, when we look at where people in these countries live, they are exposed to sea level rises, they are exposed to coastal flooding, and sadly we have seen many examples of that already in practice. Infrastructure limitations are to an extent a challenge for everybody, because of course, how do you possibly prepare for all kinds of risks? And in many countries, of course, poverty is an additional trigger for additional problems, political instability, conflict, etc., which ultimately then tend to exacerbate the impact of all these things. Now, I think what I would agree with you on is that it is important for Islamic financial institutions to adopt a proactive, forward-looking approach to pricing these risks. And as you pointed out, this will require capacity around structured projections and scenario building. And it is very important that this process be transparent and fair. The reality is, when we talk about the climate, for instance, we work with models. No model is perfect. And the process of pricing these black swans is very, very challenging. But I think the reality today is that global standards are emerging, are evolving, and obviously because climate change is making itself felt with a growing force around the world. And I think it is important for people to study what is happening and to develop a dynamic posture in this regard. As you pointed out in your earlier comments, I think culturally, Islamic finance should have an advantage in this space, given the central place of risk sharing in its ethos. But of course, there are also important considerations around social responsibility and inclusion. Now, what I would also suggest is that I think there is a need to start a thought process around innovation when it comes to these assets that we use to underpin products. The reality is the world is increasingly reshaped by this rapid technological change. So in particular, we should start thinking about is, can we start using technology development, dissemination, intellectual property. So in a sense, assets that are not physical, assets that are not immovable, but nonetheless that are significant assets, to rely more on those in developing these products, and in a sense reduce this vulnerability that these physical assets represent. And I think that is also important in the sense that as we try to create more diversified, dynamic, productive economies, these are the kinds of businesses that we need to rely increasingly. Now, what I would also say is a couple of other things. While pricing these risks is important, it is also important to develop a more sort of holistic and versatile toolkit for addressing them. So what banks need to do, what financial institutions need to do, is undertake ongoing assessments about these instruments and responses that are potentially available to them and can be activated. Another point I would mention is a lot of this discussion has focused on banks, but the reality today is that a challenge for risk pricing and mitigation today in the region is the relative underdevelopment of the insurance/takaful sector, which of course exists for the purpose of pricing and managing risks. Not only does it lag behind its global peers in terms of key penetration indicators, actually far behind, but it is also disproportionately reliant on compulsory policies, and the take-up of other policies tends to be very limited. That's obviously often the result of cost, underdeveloped markets, and limited insurance awareness. Yet insurance underwriting plays an important role in measuring and pricing risk around the world. And insurers are becoming increasingly adept at leveraging technology, for instance, sensors, drones, AI models, etc., to monitor and price risks. So I think there are opportunities in the region to offer more effective risk management through bancassurance type solutions. But also we need to start thinking about the regulatory posture around risk management through the incorporation of more insurance solutions. And finally, an important aspect of effective risk management is risk awareness. And banks, often together with insurers can play an important role in helping customers better understand and prepare for risks. And where appropriate, IFIs can introduce financial incentives encouraging customers to shift to less risky behavior, which is something that is happening to many insurers around the world. But the reality is, yes, banks need to get serious about risk, but banks also need to help countries and their customers get more serious about risk.
Thank you, Dr. Yarmo, for your insightful responses. And I think I will be continuing the focus on the bank's response and how specifically can they take actions or translate this picture that we discussed in this first intervention into action. And I think that this is where our second speaker comes in, Mr. Lilian Lufala. He's managing director at Istrat Advisory, Bahrain. He spent more than 2 decades inside an Islamic bank's treasury and capital markets function. Mr. Lilian, my question is, in your experience, what does it actually take to translate qualitative concern, like a regional conflict, pandemic or a major cyber incident into a concrete risk appetite limits that the board will own, and where is that conversation typically lost? Mr. Lilian, over to you.
Thank you. Thank you, Rashid. بسم الله الرحمن الرحيم والصلاة والسلام على سيدنا محمد وعلى آله وصحبه أجمعين. Thank you, Rashid. And again, I definitely thank the organizer for inviting me, and thanks CIBAFI for this report, which is definitely timely. And Rashid, you shared that the plan was not necessarily, I mean, it was not triggered by what happened recently since the 28th February, but definitely it shows that it's a report which is due and very useful for all Islamic banks. You mentioned that the 2 decades of my career. So yes, I spent most of my career in the GCC and in Bahrain. And for those of you who started the careers in finance in this region or elsewhere, clearly the exogenous events have been the norm rather than the exception. It was already said by Brother Rizwan. In my personal life, I saw the dot-com bubble burst. I was an equity dealer at the time, and how quickly markets can turn when a narrative breaks. We went through the 9/11 and the 9/11 and post 9/11, how a geopolitical event in the US instantly became a liquidity and reputational shock for some of the Islamic banks. I don't know, some of you might remember there was a very harsh Wall Street Journal article about Arachi supposedly funding or helping terror funding, which was untrue. But the result was some banks just stop their lines for this bank. It happened also to KFH. I remember at the time. So then came also the Second Gulf War in 2003, the 2008 global financial crisis, which and that was an interesting one, because the 2008 global financial crisis was a shock, obviously, worldwide. Initially, it was the subprime crisis, and we were quite immune as Islamic Bank at the time, at least. I'm not sure if the similar kind of structure was coming today. Maybe Islamic banks would be exposed, but at the time we were not exposed to this kind of thing, so we were more resilient during the financial crisis. But still, some of the banks, including in Bahrain, there was this first Islamic bank, which became Al Capita, was severely hit by this post-2008 global financial crisis and liquidity crunch, and had to go for Chapter 11. We had the Arab Spring in 2011 in Bahrain, especially was quite hit, and we had the 2014-16 oil price collapse, the COVID, obviously. And the COVID is an interesting part also, because it shows you that you can't really the unknown is unknown, and you can't really plan things which are completely outside the imagination of the risk manager. Who would have said that the oil price will go negative? And it happened during the COVID. And on the top of that, it was said by Dr. Yarmo, which is definitely right, is that we have watched cyber and operational risk growing as our business models become more digital. And now we are again in a regional war environment with Iran and tensions around the sea lanes and the energy flows, and direct impact on our daily life. So for the people of my generation working in Islamic banking, in Bahrain and the wider GCC, the severe exogenous events are not an abstract kind of academic thinking or category. They are simply the backdrop of our professional life. And what you are telling us, it's not the good news, is that it's you saying that this pattern is not going away. The external shocks, natural, geopolitical, cyber attacks, health, policy, are not just part of our normal operating environment, and that there are no more black swans, if I may say. And I think it was said earlier by one of the speakers, the regulators and the society, they expect the banks to be ready. They expect us to keep the critical services going, to support the customer in a way that fits also our ethical and social responsibilities. And the Islamic banks are also reminded that many of our markets are highly exposed to these shocks, and that our asset-backed nature often means the damage hits us very directly through the real economy. Recently, while preparing this webinar, there was a paper also from Deloitte just a few days ago on Islamic banking, the resilience in a geopolitically volatile environment was the title. And it had another angle, and it shows that the resilience is no longer anymore about just our structures, the asset-backed financing, the sukuk markets, the fact that we have the Sharia as a cornerstone of our regulation, but it's also about the risk judgment. Can we read the geopolitical signals? Sometimes it's tough and difficult, especially with some of the world leaders waking up and with just one tweet can change the world. But the external volatility and we should try to translate them into measurable, actionable risk insights. And finally, just before answering directly your question, is that it is really important that we and I think it's a bit thought-provoking, but you know we keep telling ourselves a story about Islamic banking, about real economy, but when you look at really what we do, our actual risk appetite frameworks and the stress tests that we take, they're very often they look very similar to those of the conventional banks. The language is conventional, Basel. The metrics are Basel. The thinking is Basel. So the Islamic part sits mostly in the contracts and in few paragraphs about CSR, but not in how we choose our priority during a crisis hit. So now just to answer directly on your question on the board and how do we turn a vague kind of fear, a war, a pandemic into concrete risk appetite limits that the board can feel responsible for and not just rubber stamps. The guide, your guide, Rashid, is quite honest about where many Islamic banks stand today. Our RAS, risk appetite statements, are still very focused on the usual financial ratios, being capital, liquidity, NPL or NPF for Islamic banks, sector and country limits. And the boards often shy away from the truly uncomfortable discussions about extreme external events. They feel, I don't know if it's because they feel too remote or too political or simply too frightening. And from my experience, there is four things really which can really help to answer your question. First, you start with stories. You stop starting with ratios and technical stuff. You come to your board with actual story of what could happen. And fortunately or unfortunately, we have many examples over the last 15 years, as we said, about things who could happen. So you gave us a typology of shocks in your report about natural disasters, geopolitical conflicts, cyber, IT failures, pandemic shocks to the financial and policy environment. And also the unknown unknowns, the famous one. But at the board level, it is much more effective to say things like, okay, just imagine that there is another health crisis that forces new lockdowns and slow down all government agencies and as well as our own staff. Or imagine that there is a coordinated cyber incident combined with a major cloud outage that affects several banks and key service providers, the AFS and other providers of payment in the region, and all at the same time. And then with the directors, they can picture the customers queuing at ATMs, the SMEs waiting desperately their payments, the staff trying to connect from home, and they can engage with capital and liquidity questions. But without that, everything seems to be very abstract. Then the second part is you try to go along with your board, because you rightly said that it's a board responsibility, with the second step, which is to translate the stories into a small number of very explicit risk appetite statements. I think it's Dr. Yamo who said that risk nowadays, risk management is much more, it's not enough explicit and much more generic than what it should be. And the guide you call in your guide for the risk appetite that openly recognize the possibility of the severe shocks, but also sets realistic expectation for how long essential services can be down, how much loss we are prepared to absorb. So instead of adding more pages of technical metrics, I think management of Islamic banks and banks in general, but Islamic banks maybe a bit more, we should just tell them, okay, in a severe shock, we aim to have critical payments, for example, and cash access services down for how many hours, non-critical services for how many days. If we intend to hold something close to me in my treasury career is capital liquidity buffers sufficient to absorb X% hit to our asset-backed portfolio from a major climate or geopolitical events in our core markets. What do we do? What's the percentage really that we target? Are we willing to sacrifice a defined portion of our return for this year's dividends to support affected communities or and PSIA profit sharing investment account holders in a severe crisis, of course within the Sharia boundaries? So once you have all these statements, Treasury, Risk and Finance can translate them into concrete limits and buffer ranges and monitor them like any other RS metric. Then the third part is the habit, making it really that this uncomfortable conversation. Human being, by definition, we don't want to talk about bad news or about bad thing, but we have to. And to avoid the reaction and to be proactive, you have to have this as a habit. Your guide, Rashid, stresses that expectations on boards have gone up. It's no longer acceptable to just leave resilience discussions to the next crisis. We need really to be prepared. And one thing very easy to do it, and a very kind of practical move, if I may say, is to schedule at least one board or board risk committee, at least session per year around a severe scenario. You run a kind of scenario exercise and explicitly ask, okay, what are we prepared to trade off? Profit versus capital, capital versus supporting vulnerable customers, growth versus resilience. The conclusion from that discussion then feed back into the next version of the risk appetite statements, into stress testing assumptions, and into the crisis playbooks. And finally, and it was mentioned earlier by one of our colleagues one of your colleagues, the lady from CIBAFI, is Maqasid al-Sharia. I strongly believe that the Islamic banks can and should be more distinctive. We have to bring Maqasid al-Sharia into the RS, not just into the product approvals as a kind of technical approval. Your guide concludes that structurally Islamic and conventional banks, they face similar vulnerabilities and they will use similar tools. And I said it's Basel centric and we have the same mindset. But it also underlines that the ethical and the social foundation of Islamic finance, including our duty to vulnerable communities, should influence our strategic priorities and our response to this kind of shocks. And that's really very, very important. And in practice, that could mean things like limiting exposure to sectors which are really essential in the society. And even if it is technically permissible to invest or to finance this kind of sector, if we feel that there will be some kind of systematically destabilizing in a crisis, then we should refrain from financing these kind of sectors. We could earmark or build some buffers for hardship restructurings and fee waivers for vulnerable clients in severe shocks within the Sharia rules. We could have also clear principles, and I'm not sure that we are, as an industry, very clear on how losses and reduced returns are shared between the shareholders and the PSI holders. We keep saying it's profit sharing investment account, but it's very theoretical. We never really tested passing losses to the PSIA or urea holders. And these points really to me, it's very important. We have to have all these points should be written inside the risk appetite statements, reviewed together with the Sharia Supervisory Board. And so what Maqasid al-Sharia becomes part of our risk governance and risk culture, not just a slogan in our annual report. Back to you, Rashid.
Thank you, Mr. Lilian. And I think that your response clearly sets recommendations to how to go from a qualitative concern such as these events to a board-owned limit. However, I think that an effective response to such events, the response of the bank, will require involvement of different levels in the management of the bank. And at the heart of this these players that will be involved is the chief risk officer. So if we put on the hat of a chief risk officer and we want to deal with unknown events, I think we will need to run non-standard scenario. So the first question would be, or like my second question to you would be, why we need to run such a non-standard scenario, and if you can walk us through what it would expose for the bank.
Yeah, that's a very, very interesting question, and a very good follow-up question to the first part. First of all, disclaimer: I've never been a chief risk officer, so I will try to put my hat. But I have many friends who are. But before I come to your scenario question, I just want to put this also in slightly, if you allow me, because we are Islamic banks, so we need to have something very specific, which is, I think, very relevant for Islamic banks, which is our religious attitude to risk and shocks. There is all the Muslim around the table and even non-Muslim who have been in Islamic banking, they know the famous hadith where a man asked the Prophet ﷺ, whether he should leave his camel untied and rely on Allah, or tie it and rely on Allah. And the Prophet response was very clear: you have to tie it and rely on Allah. And this is often quoted in hedging, but also in our context, it is extremely relevant. The reliance on Allah with the tawakkul is not a license to be passive about risk. We do our part. We have to tie the camel through planning, through buffers, through drills, scenario, as you said, and then we accept Allah's decree. And the Quran teaches us also that the shocks and the crisis, they are part of Allah's knowledge and wisdom. We said unknown unknowns, but it's known by Allah, and they are not bugs in the system. And at the same time, Allah says, and whoever relies upon Allah, then He is sufficient for him. So the message is to be realistic, to expect difficulties, but not to be paralyzed, and to combine. We have to combine preparation with hope. Sometimes our scholars, they distinguish between tawakkul, which is this active reliance on God, on Allah, that after taking the means of controlling your environment and your risk, and tawakkul, which is a kind of fake reliance where we do nothing and we just say Allah will provide. In other words, I mean, tawakkul is the faith, is the real faith. Tawakkul is more negligence, dressed up in piety, if I may say. From a risk management perspective, if we superficially say, inshallah khair, and while we have not done our proper risk appetite, proper stress testing, proper operational resilience, this is not tawakkul, it is tawakkul, it is negligence. So your guide, Rashid, emphasized that you need to anticipate, not only react, and which is, in my view, exactly in line with the prophetic advice of tie your camel and then you trust Allah. And if our boards and Sharia scholars, they internalize that, then they should actually feel religiously almost and ethically obliged to engage in this tough what-if conversation instead of avoiding them because they feel uncomfortable, or sometimes it could be politically sensitive. So to come to your question on if I were a CRO on a Bahrain-based or GCC-based Islamic bank, the kind of scenario which I will run tomorrow, as you said, I mean, your guide explicitly recommends that we move beyond generic macro scenarios into more operational and cross-border ones, and close to the reality. And as I said earlier, fortunately or unfortunately, we have many examples now over the last 10 to 20 years. So a closure of a key shipping lanes, the Strait of Hormuz, like we saw a few weeks ago, the loss of access to euro clearing, a major cloud or telecom outage. That should be this kind of specific risk that we should highlight in the scenarios. And I pick one scenario that we could do for tomorrow for a Bahrain-based Islamic bank. I will choose something which will combine geopolitical, but also financial infrastructure shock with maybe 4 ingredients. First, you could imagine a serious disruption of the traffic of through the Strait of Hormuz, and not necessarily the total closure, but enough to cause delays in oil and container flows, so less cash flow coming to your customers. Then a temporary, at the same time, loss or restriction of dollar clearing access for some of the regional banks, driven by sanctions, for example. Then potentially you could add as an ingredient a degradation of telecom and cloud services in the Gulf due to, for example, cyber incidents. And then you could also, and which is one ingredient on the top of that, which risk officers should take into consideration nowadays, is that we have a very noisy information environment nowadays, with the social media and some media outlets speculating about sanctions, about the safety of local banks, and so that could also, that could generate even more harm than what actually the bank are facing. And why I will take this combination, it's because it is absolutely realistic for our region. It directly affects the trade and energy, which is the key of our region, energy, oil and gas. And it's underpin many of our Islamic banks' business models also. It puts pressure on exactly the areas where Islamic banks have specific constraints. We need the access to the Sharia compliant, high quality liquid assets. We need to have to know, and we rely on the depth of the sukuk markets. We rely on commodity murabaha quite a lot for some of our assets and liabilities, and we depend on outsourced IT and cloud services. So if once you run such a kind of catastrophic scenario, then you have to probe 4 dimensions, which are always what CROs should do in any bank, but especially also in Islamic banks. Number one, on liquidity and funding, how fast and how far can URIA holders and depositors move if they get nervous about sanctions or about payment blockages? How many days of such outflows can we withstand before we are in trouble? What happens to our short-term dollar funding and our ability to roll commodity murabaha transaction if some counterparts step back or shorten tenors? It concretely happened over the last few weeks for some of the Islamic banks in Bahrain. Do we have pre-arranged Sharia compliant contingency lines or central bank facilities that are actually usable under that stress? You mentioned, Rashid, that during the COVID, in some jurisdictions where there are Islamic banks, there was no Sharia compliant lines. We are fortunate in Bahrain. The central bank, CBB, has been over the last 20 plus years doing a fantastic job to help Islamic banks. Then the second part is on the credit and the market risk. How do we re-estimate the cash flow of our customers, especially trade finance customers and energy link clients? Alba, Babco, all these big companies have been hit by the recent crisis, and definitely there was financing and heavy exposure for many Islamic banks on financing these 2 blue chip in Bahrain, which obliges you move from stressed but still solvent into non-performing in that environment. What will happen also outside the facilities, but more on your fixed income or sukuk portfolio, if the spreads widen and liquidity disappears for a period on the sukuk? How much of our capital buffer and liquidity coverage would that consume? Then the third part will be on the operational resilience. If the cloud and telecom performance degrades, which services fall first? Payments, digital channels, which are so important for digital banks nowadays, core banking, are our stated kind of maximum tolerable downtimes realistic, or are they just the numbers? We have to be very specific. Do we have tested failover options to alternative regions? Many banks over the last few weeks start rethinking. They put some of their backup in other GCC countries, and then you realize that the whole GCC could be impacted. So you should think to put some of your disaster sites or recovery sites outside the region. And finally, on Sharia and Maqasid al-Sharia, in that kind of stress, how do we prioritize for relief and support. The large corporates, the SMEs, the households, how do we treat the PSIA holders? What will be our guiding principles? How do we share losses? That's a very important part because, again, it has not been tested yet. If we need to reduce returns on PSI urea holders, or even worse, I mean, take some of their capital, how do we do that? How do we prepare and communicate this to the customers? Sometimes, if in very stressed scenario, you could end up also with in a situation where the bank has to ration liquidity. So do we choose? Do we make? I mean, the choice that we'll make will reflect our Islamic value. Are we going to support essential goods, public services, vulnerable communities, or are we going to be simply following short-term profit logic and go for our larger customers? So for me, that kind of scenario is a very honest mirror. It will show us whether our resilience is generally shaped by our identity and by our structures and our market, whether when things get through, we behave essentially like any other bank, but with different documentation. We should not. We should really try to see, and Dr. Yamo said it, and it's not only Islamic banks, even conventional banks have to have. It's not only surviving during crisis, is how you can have a positive impact for the resilience of the whole country.
Thank you, Mr. Williams. So if we have people from risk management units, I think you have now enough guidelines to build a non-standard scenario and to make your bank ready for future or to respond to future disruptive events. And so now you just need to move from the zone of tawakkul to the zone of tawakkul.
Exactly.
Yeah. So thank you so much, Mr. Lilian, for your responses. Now we will move to the third speaker, Dr. Sultan Hidayat. He is the director of Indonesia's National Committee for Islamic Economy and Finance and the associate professor at Ganadharma University. From the first two speakers, we moved or we heard where the shocks come from and what an Islamic banks can do internally to respond to these shocks. However, the Islamic banks they cannot prepare alone for such shocks. Because they are inside an ecosystem of supervisors, central banks, Sharia board, and social Islamic finance institutions. So to bring this third dimension, I would ask Dr. Sultan to outline the structure of Indonesia's Islamic finance ecosystem, as it is one of the ecosystems that are rich in terms of players, and to highlight the coordination gaps and the effective mechanisms that an Islamic banks can leverage to manage any future cross-border shocks. Over to you, Dr. Sultan.
Thank you, Rashid. Can you hear me?
Yes, we can hear you.
Bismillahirrahmanirrahim. Alhamdulillah, wassalatu wassalamu ala rasulillah wa ala alihi wa sahbihi wa mawala. La hawla wa la quwata illa billah. Rabbi shrah li sadri wa yassir li amri wa hlul 'uqdatan min lisani yafqahu qawli. First of all, I would like to thank BIBF and CIBAFI for having me. And also, this is also a good chance for me to share about Islamic economy and finance in Indonesia. By the way, let me share my slide. Just 1 second. Oh, sorry. I think I have some technical problem. Yeah. Coming back to your question, the Indonesia has a different approach in developing Islamic economy and finance. We are not focusing only on finance, but we focus on Islamic economy and finance, which include also the real sectors, in which, as you know, that there is halal food industry, and then also modest fashion, and then also halal pharmaceutical, and also cosmetics, yeah, and halal media and recreation, and also Muslim friendly travel. So that's the approach taken by Indonesia, which is, as you know, that Islamic finance can only fund halal industry. So we need to develop the halal industry. So it will create demand for Islamic finance. And as you mentioned, that in terms of the ecosystem of Islamic economy and finance in Indonesia, it consists of several layers, because our demographic profiles in terms of population, many people are still unbankable, and some of them even categorized as mustahik, the recipients of zakah, the 8 recipients, which some of them are the needy and the poor, fuqara wa masakin, in which they will not be able to access commercial finance. They should be helped and assisted by Islamic social finance. This is where in Indonesia we have several, and of course we have the National Zakah Agency, and at the same time privately run zakah agencies, where they distribute zakah not only in the form of consumptive zakah, but also productive zakah. What it means by productive zakah, some of the portion of the zakah is given to the mustahik, to the recipient, in the form of seed capital to start nano business, or maybe micro business at least, not even small. Yeah, in the form of, for example, they can start workshop, yeah, a business, yeah, and also fried chicken business, small coffee shop business, and other thing. And by using the seed capital from zakah, and they are also assisted by the agencies on how to run the business until they can be they can reach the level of muzaki, yeah, the payer of zakah. So this is monitored by the zakah institution from time to time. Every morning, for example, I always receive reports from one of the institution, in which they report, for example, Mr. Ahmad about 6 months ago has had, let's say, 1.3 million rupiah monthly income, and after getting the productive zakah, and then they start, for example, chicken business, yeah, fried chicken business. Now his income has improved into, let's say, 2 million rupiah, until he reached the nisab level, yeah. And when it comes to that, once he passed the nisab level, he will be passed into the commercial finance, but not directly commercial finance. There is also blended institution in Indonesia, where there is social and commercial finance are in one place, yeah, in the form of Islamic microfinance institution, which is the legal basis. The basis for it is cooperative, known in Indonesia as Baitul Mal wa Tamwil. Baitul Mal, collecting the social finance, and will not distribute all of them, yeah, for example, consumptive purposes, but at the same time also collect from the members, cooperative members, in the form of deposit, where this deposit will be channeled into commercial financing, like just like the bank, murabaha, musyarakah, mudharabah. So, but in case, for example, because these are still micro businesses, yeah, once they got financing, for example, due to regular or normal circumstances, the business did not run successfully, so the financing still can be recovered by the social finance collector. So this is called blended finance under the one roof, which is called Baitul Mal wa Tamwil. And once the business is becoming bigger and bigger and reach the status of really bankable status, then purely commercial finance will start giving access to them, yeah, in the form of Islamic banks, in the form of a non-banking financial institution, like so for example, like pawnbroking, Islamic pawnbroking, Islamic fintech, and Islamic multi-finance institution. So once they can become bigger and bigger, they can access also Islamic capital market. So in Indonesia, there are layers, Rashid, that of Islamic finance. And in fact, if you look at the Islamic bank market share in Indonesia, is very small, only 7.5. But it doesn't mean that it reflects the whole Islamic finance in Indonesia. The total market share of Islamic finance in Indonesia is actually 30%. But mostly are not from the Islamic bank, are from other sector, namely capital market, sukuk, for example. Because Indonesian government is one of the big issuer of sukuk, and most importantly also from the Islamic microfinance institution, and from Hajj fund, and also from Islamic security or social security fund based on Sharia compliant services. So in Indonesia, you cannot look at, for example, Islamic bank, because there are multiple unbankable. So we sometimes, when Indonesian representative always talk about Islamic bank only represent 7.5% of Indonesian Islamic finance, I always you cannot highlight that point, because in reality now I have actually on my slide, combining the whole ecosystem already represent 30%. So this is, and there are many regulators that supervise. For example, OJK, Financial Services Authority, only supervise the Islamic banking, capital market, and non-banking financial institution, while the cooperative are supervised by Ministry of Cooperative, and because they are cooperative by nature, and other for example, like Islamic Social Finance Institution, there is National Zakat Agency and National Wakaf Agency, and there is also Ministry of Religious Affairs. Too many regulators are there, and to coordinate all these stakeholders, there is one committee, which is called National Committee for Islamic Economy and Finance, which is my institution, KNIKS, that coordinates the whole stakeholders. And in order to make the coordination smooth, we have what we call as the master plan of the Islamic economy and finance. And this 5 years master plan, at the moment, the second one, Alhamdulillah, it has been aligned with the national development plans, both long term, which is for 20 years, and also the medium term 5 years, especially the medium term. Basically, whatever Islamic economic and financial contents inside the national medium-term development plans are put into more details in this master plan 2025-2029, with clear target what Indonesia wants to achieve. For example, at the moment, under the State of the Global Islamic Economy report, Indonesia is ranked third at the moment, but by 2029, inshallah, we are targeting to reach number 1. So this is maybe my overall explanation about the Islamic economic and financial ecosystem in Indonesia.
Thank you, Dr. Sultan. So moving to my second question, in my view, this defines what Islamic finance is for. Indonesia is one of the countries with the most developed integrations between commercial Islamic finance and social finance instruments. So how can we, in case, for example, of an shock or an extreme disruptive event, how can we make sure that this integration delivers for affected communities in real time, and that the social finance plays its real role in responding to the implications or the impact of such events? But for because we don't have enough time, so in 5 minutes, please.
So I will take the example of COVID-19. You know how easy in Indonesia to let's say, for example, to donate or to pay zakah or to pay sadaqah or even to pay wakaf is just using your mobile. And in fact, every time you do the transaction on your mobile, at the end of your transaction, the bank will ask you, will you donate certain rupiah for they give you option zakah, sadaqah, or awqaf, for example, cash wakaf. And this is how it is connected between, and normally the Islamic Bank will collaborate with the zakah and awqaf agencies, yeah, in order to manage them. And not only in the banking, even in our capital market. You know, one of our before I go to the capital market, in the banking even there is cash wakaf link deposit. So you even can donate cash wakaf, and the cash wakaf will be put under the time deposit or investment account, yeah, and the return will not be given to you. The return will be given for social purposes, yeah, which is also normally targeted. In capital market, we have also what we call as cash wakaf link sukuk, where you can also donate cash wakaf, and then later on will be invested in sukuk, and the return will be used for social purposes. And even we have what we call as wakaf share, and then insurance benefit, wakaf insurance benefit, and other things, yeah, to show how. Yeah, coming back to your question again, during the COVID-19, one of the main instruments that can make our people survive is actually the Islamic social finance. Indonesians are quite well known to be one of the most generous people in the world. Yeah, Alhamdulillah, I experienced also when we were locked down here, and many people also lost their jobs, but they started to have a business, right? And then we help each other by buying foods, buying things from our neighbors, and also the zakah agencies help them also. Those who lost the job, they give this zakah, the one I mentioned to you, both consumptive zakah and also productive zakah. So when they lost the job, at least they can have seed capital to start a micro business. This micro business make us survive. Also in the case of natural disaster, for example, recently we have floods in Sumatra, for example. So the money is used not only to help them for natural recovery, yeah, disaster recovery, but also for them to start new life, yeah. And Alhamdulillah, that is really helpful. And I totally believe this is the solution, even if this geopolitical tension is going on. And I'm sure that one of the ways to minimize the impact is through Islamic social finance. I'll give back to you because 5 minutes on.
Thank you, Dr. Sultan, and thank you to all the other speakers for the insightful thoughts shared during this panel. I know that we exceeded the allocated time for the webinar by 6 minutes exactly, but I think I will still allocate another 5 minutes for any important questions from the audience. So if there are any questions, yeah, I can see that there are questions addressed to Dr. Yarmo. In crisis, what should Islamic banks prioritize? Profitability, customer support, or financial stability? Over to you, Dr. Yarmo, if you can respond to this question.
I appreciate the question. I'm not sure that I'm the best qualified person to answer it. I think the reality is we go back to this call for agility in response to crises, and as Lilian, for instance, highlighted, these crises, they can assume all kinds of forms. They can be almost, as he suggested, compound crises, many shocks at the same time. So the reality is you may not really have a choice, and I think I would refer to what Lilian said earlier. The mandate, the responsibility, if you like, of Islamic financial institutions is multi-layered, and I think integral to that response, therefore, has to be the ability to strike a balance between these different objectives.
Maybe one word, Rashid, on this, if you allow me, is that liquidity is what puts a bank on its knees. I mean, if you go back to Lehman Brothers, for example, I mean, it's because of liquidity, or even Credit Suisse more recently. It's because of liquidity that the bank disappeared. So definitely, if you have to pick one in terms of survival mode, you have to make sure you're stable in terms of liquidity. Profitability should be last in this kind of huge crisis, of course.
Thank you. Okay. Okay, my second question is to you, Mr. Lilian. So how can emerging Islamic banks in frontier markets like Ethiopia build the resilience frameworks without the presence of a deep secondary sukuk markets? And the second part of the question, furthermore, what role can digital banking and AI-driven risk analytics play in strengthening Sharia-compliant resilience models?
I have 2 hours or just 2 minutes? No, I mean, on the second part, I strongly believe that AI can't really help much in this kind of really severe shocks crisis because there's so much unknown, and it can help and assist decision-making process, but it's not going to help you to predict the crisis or to what will be the next one. I'm sure if you go to ChatGPT or any of this AI thing, you may ask what's the next crisis, and I'm sure that they will come with an answer because they are programmed to give you answer on anything. But I'm not sure it would be really the best thing. The first part of the question is more interesting. Is what do you do in new frontier market? And mashallah, there is a lot of new frontier market coming up in East Africa, like Ethiopia mentioned by the participants, but also in Central Asia, and we saw Kazakhstan, Uzbekistan, and other countries coming to the Islamic banking, and the answer really, I don't really have a clear answer. It's just it's going to be very difficult because it's already difficult for us in Bahrain, where we have a mature Islamic banking market regulation, some rule books who are dedicated to Islamic banking, or similarly to some of our neighbor countries in the UAE or others. And already for us as Islamic banks, because we are smaller in size, sometimes it's difficult to navigate through this crisis. So clearly, if you are in a very niche market in a nascent Islamic banking industry in one of these new frontier markets, if there is a shock, there will be really a big issue. Now, the good thing also is sometimes shocks, smaller you are more agile, and you can avoid the shocks. If, for example, when the latest crisis, the Iran conflict started, I was in contact with many of my colleagues in Bahrain and the wider GCC colleagues on treasury and capital markets, and you could clearly see that some of the largest banks, the FAB, the QNB, and all this, they could, to an extent, have more impact than smaller banks who were relying more on local funding than larger banks in the GCC who were more dependent on outsiders. Because first, people who live in case of big shocks and a crisis which will come to you, it's your neighbors are going to help you first. It's not people very far away who are more opportunistic when they come to the GCC.
Yeah, thank you.
But I think one point maybe to consider in that context as well is, and I think the Iran crisis has highlighted the importance of this, is we still think of these issues primarily in the national context. And I think this region, whether it's the GCC or it's the broader Middle East, needs to get more serious about integration, including integration in finance.
Okay, thank you. Last question before closing, addressed to Dr. Sultan. In light of the disruptions to agricultural input supply chains caused by the closure of the Strait of Hormuz, how can halal producers effectively manage supply chain risks while maintaining compliance with halal certification requirements and preserving product quality?
Yeah, what we call the situation, this give us clear a big lesson that self-sufficiency is very important. And luckily, although it was not supported that much before, now the Indonesian government focuses on establishing the self-sufficiency, and one of them is in terms of food security and also agricultural sectors. And this is where also You know, and if we look at the macro data, halal value chain in Indonesia contribute around 27%, and one of the main contributors is agricultural sector, because Indonesia is agricultural country, based country, and this is now and cooperating among the Islamic, the Muslim countries need to be strengthened. Although this is not the case right now, yeah. But in the future, so you know, you have to find a new export destination. You cannot rely on your regular basis. You must have diversification in your exporting destination, export countries that destination. So with this diversification, we hope that if this side there is a problem, we can go to other places. Maybe diversification is the key.
Thank you, Dr. Sultan. Thank you all, and back to Brother Al-Fatih for the closing.
MashaAllah. Alhamdulillah, what a very productive 1 hour 45 minutes. We have definitely come to an end of our webinar. And ladies and gentlemen, on behalf of BIBF and CIBAFI, we would like to extend our very sincere appreciation to our distinguished speakers and our moderator for sharing their valuable insights and expertise. We'd also like to thank all the participants from all around the world who joined us today for all their attention and engagement throughout the session. Please don't forget to visit us, follow BIBF and CIBAFI on our official social media platforms to stay updated on our upcoming events, research publications, and initiatives supporting the advancement of the Islamic financial services industry. I guess before we conclude, in keeping with the sunnah of our beloved Prophet ﷺ, let's end this gathering with a dua of kafaratul majlis. سبحانك اللهم وبحمدك أشهد أن لا إله إلا أنت أستغفرك وأتوب إليك والسلام عليكم ورحمة الله وبركاته.
Alaikum salam wa rahmatullahi wa barakatuh.
Alaikum salam.
Thank you so
Thank you very much.
Thank you.
Take care. Assalamu alaikum.
Salam.
Thank you, Jarmo.